Neelkanth Mishra, India Equity Strategist with Credit Suisse. Neelkanth, good morning. Thank you for joining us. Before I throw a pointed budget-specific question at you, are you a bit surprised with what's going on in the market? 6 weeks ago, 8 weeks ago, if you would have constructed a scenario that Nifty would be 300-400 points away from a record all-time high, that would have looked like a laughable scenario. But markets have really managed to climb the wall of worry. What's going on? Is it only domestic liquidity or something more which we can't figure out?
No, I think there are two things here. One is a very important force is domestic liquidity. I think for the first time in our market, we are seeing domestic mutual fund flows matching that of foreign flows. Now, in the past, and if you go even by ownership or trading volumes, the FPIs have been 4 times the size of domestic mutual funds, and what we've seen the last 3-4 months is that the net buying volumes in the domestics are now comparing and matching what we are seeing for the foreigners. So that's a very important transition. I think this is a transition that can possibly last as well. I'm not as clear on the impact on pricing for markets, but in the near term, I think it's a very important force that has emerged, which I think most people, including me, were quite blindsided by. Now, the second issue is that there is a disorientation in the market. I don't mean it in a very critical sense. We generally in the markets, people compare any information to expectations. I was meeting investors in the US last week, and early last week, when a company reported numbers, 3 investors told me, great results, now what's the problem with demonetization? And I checked back, and actually the company which is growing volumes in the mid-teens had reported 0% volume growth. Margins had fallen, profits had fallen. So it's clearly, so we thought that it was actually quite a terrible result. So it's a problem of not having the right expectations, and therefore people not knowing what to act on. Consensus numbers are not very reliable at this stage because people don't really know, and therefore every small information, one small bank reports decent numbers and people say, see no impact of demonetization, but boss, credit growth is at a 50-year low. There is a problem. It may not be in some of the smaller banks, but it is somewhere in the system. So I think there is that's the second most important fact, that there is a disorientation. We don't know what expectations are, and because prices are holding up, no one wants to sell. And there is a third factor, I think, which is a relatively smaller factor, which has always been there for India, which is the TINA factor. There is no alternative. There are so many big uncertainties, and geopolitical uncertainties, trade-related uncertainties, currency, interest rate-related uncertainties. So there is a lot happening in the world right now, which makes people worry about the prospects for most economies. But India comes across as a fairly insulated economy from some of those changes. And for good or for bad, the recent changes, the turbulence due to demonetization or the upcoming GST is expected to be, maybe 12-15. People think it's 6 months. We think it's 12-15 months of turbulence. But 2-3 years out, we all think it's all great, right? So why sell? It is when you start to see sustained earnings downgrades, that is when you will see really the pricing start to reflect that in the market.
Well, Neelkanth, if last year is anything to go by, I think we should completely ignore any and every estimate. What with the Brexit call going wrong, and then, of course, the big one, Donald Trump as well. But, again, talking about expectations, Neelkanth, the other one is about the upcoming state elections, the results of which are going to trickle down towards the first part of March. And, again, you're seeing those analyst reports, WhatsApp forwards, emails, all talking about whether BJP is going to get UP or Goa, etc., etc. Do you think it's going to be that market moving an event?
I don't think so. I've never been a big fan of even the budget. I think the only thing that the market got excited about in the budget, in my view, was 2 things maybe. One was that the definition of long-term capital gains tax was not changed for equities, and the second was that it was a very disciplined, sane budget. But other than that, I mean, all the expectations that were there of, oh, there will be massive demand stimulus, there will be complete transformation of tax rules. I mean, so we have been saying, and Nikunj knows for the last several years, that the union budget, I think there's too much of tamasha around it. It's actually a simple budget document. Similarly, state elections are about the state. UP is a very important state. I think it's very important that we get a stable government, whoever comes to power. It's very important that the party coming to power interprets its verdict in a very progressive way. UP has made some very important changes in the past 2-3 years, built expressways, metro rail stations, expanded its police force strength, expanded health services, emergency services. So there's a lot of good stuff happening there, and I think one only hopes that that will continue. UP's budget is 20% as large as, it is nearly a fifth as much as that of the central government. No one really tracks their budget. Those are things that I would like to look at. Election results will come and go. I don't think they should matter that much to the markets.
Neelkanth, good morning. Neeraj here. We met at our pre-budget event last year, and what I distinctly remember, amongst other things, is you being one of the earliest identifiers of a potential market rally in the metal names. You were a minority. You were sort of anti-consensus. My question to you right now is, while everything is looking hunky-dory for the markets, every opinion is that there is a possibility that we could head higher. Are you anti-consensus somewhere on a specific space, on the market behavior, or something else?
I would say, and having talked to a large number of investors in the past month and met them across the world, I think that the trade for this year could be IT services. I think that it's a decent sector. It's a very, compared to most other companies in India, I think it has a great corporate governance track record. The balance sheets are good, cash flows are good. I think there is the industry growth decline in dollar revenues from, say, mid-teens, high teens to low double digits is being construed as a structural decline, that these companies have become too big, or that cloud computing requires less manpower, and so on and so forth. I think there is a very big cyclical element there, that the global economy was slowing, financial services, metals and mining, oil and gas, these are nearly half their revenues for the industry, and they were, as we all know, having a near-death experience in the last couple of years. And they have rebounded, at least their stocks have rebounded, and quite meaningfully, and their earnings expectations are also rebounding, which means that the pressure or the cyclical downturn that you're facing is perhaps reversing. The only problem is the regulatory problem in the US, which in my view is more of an overhang. So I suspect that the stocks may not move meaningfully higher before we get to know what is it that the US will eventually do. There's a lot of noise, and given how radical some of the moves have been, I mean, anything is possible. And therefore, no investor is going to, most investors would not want to be in the sector before the decision is made. So it's an overhang. But I think that once that overhang is done, there is a potential for meaningful re-rating in the sector.
Do you think, we will see a big bang news flow from some of the IT companies? They're sitting on a lot of cash. Up until now, Indian IT companies, with the exception of Wipro, they've managed to grow organically. Do you think now we could see a lot of inorganic moves, cash could be put to work? The kind of cash some of these companies are sitting on is actually getting better, and that's enviable. Do you think, now they've been pushed to a corner and they will act fast because it's a matter of survival?
So I think, just as, it's a great question. I think the problem with the sector right now is, just as the investors are a bit uncertain as to where policy will be, I think so will the companies be. And if at all some M&A has to happen, it will have to happen after the announcement, and we at least get some clarity on which way policy is headed. So should you be leasing real estate in India, or should you be leasing real estate in the US? If there is an underutilized US company which is been seeing troubled times, maybe it's a good time to acquire them. So if there is something very meaningful happening at the policy front, then you need to respond to that, and maybe this cash can actually be put to good use there. You can actually acquire. So so instead of ramping up massively your hiring, and which is a very organic process which could take several quarters. One very speedy way to get a lot of engineers on board, and so that you get your H1B ratios in line, could be just to acquire a firm. So that's what I mean. I think having a good balance sheet is great, right? I mean, it gives you a lot of flexibility and room for maneuver. But I suspect that we will not see any such action till we know what the US government is intending.
So Neelkanth, I mean, just to follow up on IT, how do you time your investment in IT? Do you jump in right away because the herd is so anti-IT right now? Do you wait for some clarity from whether or not this H1B visa bill actually gets approved? Or do you wait for some big bang announcement from some of the Indian IT players?
No, so we have so IT. I mean, 2 IT stocks are among our top picks, but the smaller ones, and we have a neutral rating on most of the larger IT names. But I would say that if you have to start accumulating and waiting for that down dip that you don't know if it will last 1 week or 1 month or 1 day. Whenever the announcement comes, I mean, you need to be very agile and alert to be actually able to buy in that. And if everyone is waiting for that event, maybe the down dip will not be there. So if you see value, I mean, I think so if a sector is trading, I mean, if a stock is trading at 10, 11 times earnings, then maybe it's less than that. A lot of those risks, I would say, are priced in. So yeah, so I mean, on some of the names, there are top buys for the year, and we would buy right now.
I'm going back to that conversation and asking you a second question based on that. While you were the earlier identifiers in the metal space, do you think that basket has done its course? Because we are also seeing the last couple of weeks global metal prices come off a bit.
Yeah, so see, you have to understand that there was a lot of expectation around a fiscal boost when the new US establishment came up, and that globally policy was going to shift from monetary to fiscal, and therefore metal prices will go up. And now that some of those policies are coming out and people are realizing that they actually could trigger uncertainty, meaning that the fiscal policy, of course, we'll see what happens later, but and on geopolitical level, at the level, there is a lot of uncertainty. So then perhaps some prices have come off a bit. But the good thing about metals, I'm fond of them because I've covered them for 10 years, is that they reflect reality. See, other than in, say, the non-ferrous side where there is a bit of speculative element, I think steel is about real demand and supply. I mean, there is not too much speculation you can do, maybe some in China, but otherwise it's very real. I mean, if there is a steel demand, prices will go up. If it's not, it will fall. Now, what we are seeing in terms of global growth this year is 2017 is expected to be the best since 2011. These are projections, I know, and as we discussed earlier, some of these projections have to be taken with a pinch of salt. But I mean, who would have thought that Europe would be growing at 2%? Looks like a small number, but it's a very large economy. So half a percent point is actually quite a meaningful amount of growth. So I would say that on the steels we remain positive. On the non-ferrous side also, maybe not so much on aluminium, but a bit more on zinc. So there are preferences and based on demand supply for specific metals. But on the whole, I think that trade would still be on.
Metals, Neelkanth, we've talked about IT. Where else do you see growth on the table?
I think that interest rates will surprise on the downside this year. If you see inflation expectations of consensus, and as I said, I mean, right now no one really believes consensus anyway. So you don't know if buy side is acting on that consensus number or not. But with that disclaimer, consensus expects that end of the year inflation will go back to 5%, and this is classic inflation expectations stickiness, right? So they're sticky not just for the normal economic participant, but it seems to be pretty sticky for economic forecasters as well. Now, our view is that with persistent oversupply emerging in most food categories in India, there will be some where there is a supply problem that will emerge, and supply chains have been disrupted in the last 2-3 months. But on the whole, 12 months down the line, I would expect food inflation to be much lower than what consensus expects. And that should give a lot more leeway for the RBI to cut rates. It should also, given that loan growth is at a 50-year low, and using the steel example again, if your utilization drops from 100 to 90, prices don't really fall. Utilization drops from 90 to 80 and below, and knives come out and people start competing on pricing. I think some recent rate cuts that we have seen from large banks are also a reflection of significant oversupply in the banking system because of very weak demand. So if your loan growth is at a 50-year low, that suggests that now, so when loan growth fell from say high teens to low teens or maybe low double digits, it was the smaller PSU banks which were losing the market share, and the bigger banks are still growing at 20% or 12-15%. Now that system loan growth is at 6%, knives are coming out, and I think you will see more competitive rate cuts. So interest rates in the economy, not just policy rates, should by the end of the year be a lot lower than what people expect them to be right now. And so if you are a company which is, and some of the budget related policies that the government is taking, the government has decided we will not stimulate demand. We would rather let interest rates fall and let the market stimulate demand. I think it's a very prudent step, but it takes time to play out in the market, and it will play out through lower interest rates in the real economy. And so if you are a highly leveraged company, some of them you have to take corporate governance risk on the table as well, but if you're a highly leveraged company with very large interest costs, you should be looking at them as well.
Neelkanth, you not like PSU banks, and there are obvious factors why you not like PSU banks. Now, if you're making a case of economic recovery, uptick in the metal cycle, the problem points are getting over, SR has managed to pay back to the banks, other corporates are doing the same. Can PSU banks spring in a surprise? Let's be real, I mean, they are cheap.
The fact that they have not fallen meaningfully, and in fact, in the last 3-4 months they've held up. I mean, given the kind of pain that can emerge in them, I think is already. I think the market is acknowledging the fact that they're very cheap. My problem is that look, if system loan growth is weak and corporate credit growth is actually negative, right? And given all the uncertainty that we are seeing this year, so people are uncertain about the impact of demonetization. The markets, I think a lot of people tend to be very speculative. But if you're a business investor, if you're an entrepreneur or a business owner, this is not a year where you're going to invest anything if you don't need to, right? GST is coming. We don't know what how disruptive it can be. There's a lot of global uncertainty. So you'd rather wait another year. So corporate credit growth this year is going to be pretty bad. I mean, it was pretty bad last year. You would have thought it was the worst. It should rebound this year. I fear not, especially if inflation is going to come off. I think that's even worse for credit growth. So you need to compete in the retail market. Now, in the retail market, and which is why the large PSU banks are cutting rates, right? Because they can't compete on product, processes, and people, and therefore they compete on price. Now, so you have low growth in the area where you are focused on and where you have perhaps some more experience. And on top of that, the largest competitors are competing on price. I think that's terrible. And your costs keep going up. So I take your point that on the NPA side, perhaps things are not getting any worse. But that situation, at least in our minds, was crossed in March, April last year when we upgraded the metals. The NPA, but some of the companies are really broken. On the metal side as well, I mean, the really problem assets are broken. I mean, you cannot do away with less than, or you cannot get away with less than 50% cuts to your exposures in most of these companies. True. So, right. So I don't think there's a much positive surprise that can come from there. But yes, fundamentally on the P&L side, we see significant risk going ahead.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.